Welcome to the STR Data Lab.
Hello and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today again by my trusty co-host, Scott Sage. Scott, happy December.
Happy December. Happy holidays. Which Christmas song is stuck in your head these days?
The Grinch. My kids love that. It's a great mix of there's an old version, a new one, and there's a couple different new ones, but it makes them giggle so much when they hear the Grinch song. We play it pretty often.
Me too. I still giggle. All right. Well, we're in December, which means it's time to recap November. And maybe the headline, Jamie, would be as we look across the 5 key metrics, ADR, occupancy, RevPAR, listings growth, and demand growth, all positive signals year over year. What do we got?
Yeah. So, and when you look at it, and jumps out to me is demand was positive again, occupancy up roughly 3%. That's a great number. But I think what most people's eyes go to is ADR. We've been seeing sort of good, not great ADR growth. In November came in at a very positive 7%. I think it is important to note, and I know you're going to hate me for this in the first 2 minutes of the episode, throwing a big caveat on here. Do you remember what ADR growth was this time last year?
No.
So this time last year, ADR was falling, and it fell by a pretty significant 3.9%. And when we're at this time last year, the November number was the biggest decline that we sort of saw. So all to say is we had a pretty easy comp up against what the growth was or the decline was last year, which really helped we went from 5.5% last month growth to 7% this month. And when you look at a sort of stacked 2-year basis, we're pretty much even. But I think that just shows that, and we are clearly in rate growth territory, and we've moved past this sort of falling rate, having to cut costs or having to cut rates to sort of maintain occupancy. That we're moving into a little bit stronger pricing power for the average host out there.
Yeah, and to be clear, I'm pro caveat. But Jamie, help us understand, this year over year, the delta we're seeing here in ADR. You're right, it is strong and it's encouraging. What is underpinning this growth in rate?
Yeah, underpinning it all is sort of the strength in demand and decelerating supply growth. So from and another sort of this year data point, you want to take a guess on what supply growth was this time last year?
10%.
That's pretty freaking close. It was in November of last year, supply was up 15%, available listings. And then in December, it was up 12%. So this time last year, we were growing 10 to 15%. Now we're growing supply at 4%, specifically 3.9%. So we've seen a pretty stark deceleration in supply growth over this past year, which given demand's growing 5-6%, we're getting some pretty stout occupancy gains, 2 to 3%, and over the past couple of months, which means you're doing better in terms of booking activity when they were last year. And that's sort of helping in terms of pricing power.
I mean, it does feel as though we've been saying a similar story in each of these monthly recaps, right? Supply growth falling year over year while demand growth continues to rise, which is a good thing. And an output of those two can be an increase in rate. Just fewer competitors in the market, you can take price. So that does make sense. And then we also let's talk supply. So what are we seeing in supply? And maybe can you break it down by markets, any outliers or anything standing out when you look at different market types, Jamie?
Yeah. So when we look at different market types, and that's one of the ways I like to start understanding supply, because every market's different. Every location type is different in terms of what we're seeing in terms of the trend, which is why and I always start whenever I go in terms of analyzing a market, like looking at supply growth. And it can really be a sort of drastic distant difference across markets. So urban markets were essentially flat. We were down last month 1%. Now we're up 1%. So hovering right around zero. Suburban still and running around 1 to 2%. Very strong growth still in small city rural, up over 11%. And I think one of the most telling type markets are the traditional vacation rental markets. So coastal mountain, they were the ones that were growing in 10-15% last year. And now they're only growing and mountains up 2%, coastal markets only up 4%. So these are typically where we see the most investment coming in, people sort of buying homes specifically to rent out as a sort of full-time short-term rental. And this is where we've seen a lot of the deceleration take place over the past year.
Key drivers of that deceleration, Jamie. I mean, we hear anecdotally housing prices, mortgage rates, regulation, all fair in each of these markets, or what do you think is really driving it, particularly maybe in those mountain coastal towns where we're seeing the greatest decline?
Yeah. And what's really interesting, if you look at housing prices over the past year across all different location types, and we're sort of flat to slightly up. So on the year-over-year dynamic, it's definitely not housing prices that are and continue to push up that is driving sort of the lower investment. Though if you look at each of the location types compared to 2019, that's where you see a big differentiation with significantly higher appreciation across the coastal mountain areas and lower appreciation in both the small cities and even some of the large cities that maybe didn't see as much in migration in 2021 and 2022. So that's one. And then when you look at interest rates, they're still hurting new investment. When we look at just over the past few months, so I follow and mortgage news daily. They're putting the most recent 30-year fixed rate mortgage at roughly 7% today. And if you go back to just like back in September, we got down close to 6.1%. So we've seen a really strong reacceleration in rates, where I think most industry participants were sort of and looking at that downward trend from May, where we were up over 7%, down, and just 4 months later, down to 6.1%, and expected that to continue down. And we just and haven't seen it. Expectations have changed. Maybe we'll talk about that along with and what else happened in November with the or even October, sort of the expectations around the election and outcomes shifting, which has really changed and the sort of market for investment as we look forward to 2025.
All right, that's a good place to go next as we look forward to 25. What are some of the key economic drivers we're seeing around inflation, Fed decision making, influencing the space we operate in?
Yeah. So there's maybe two different measures around inflation that and the Fed's looking at. One is just like what's happening in terms of the raw inflation numbers. And we just got the sort of November number, which came in at 2.7%, a slight acceleration from October, which was 2.6, but still nothing to be concerned about. And that given those numbers, we'd expect the Fed to keep cutting rates and that maybe there'd be 3 to 4 cuts in 2025. What is another sort of measure that the Fed's looking at, though, is inflation expectations. And that is where we've seen the numbers come up, where investors, market participants are expecting more inflation with the upcoming Trump administration. And a large part of that is the potential of the sort of policies that he's floated during the campaign that they could be inflationary. So you sort of run through some of the key proposals, one of the extending the 2017 tax cuts, sort of further supporting the overall economy when it's already doing pretty well. There's expected cuts around immigration, all held equal. If there's fewer workers, you got to pay your workers more, which then becomes further inflationary. And then tariffs. Tariffs are a tax on consumers. And if we see broad-based tariffs sort of enacted, that could potentially be inflationary. Now, you go back and look at the sort of tariffs applied during the first Trump administration, there really wasn't that much sort of measured inflation outside of the sort of key areas that the sort of tariffs went in. It was like, remember, go back to refrigerators and dishwashers, and they're very targeted. But now if we go into a more broad-based tariff approach, that could mean more broad-based inflation coming in. And in 2018, 2019, the Fed was much more worried about disinflation, given that we were in a very low inflation environment, as opposed to now and we've gone through 2 years of well above sort of average inflation. And the Fed is very focused on bringing those inflation numbers down. And that could be counterproductive. So mixed signals there on inflation. But if you're just looking at on how inflation expectations have changed, that could mean fewer rate cuts from the Fed in 2015. And that's what maybe some of the bond markets have sort of reacted to, is that rates could be higher for longer.
And we've seen the markets react. I mean, let's stay on the Trump presidency here and what this might mean for the industry. You started to call out a few potential drivers of change that could flow through to short-term rentals. I mean, it's interesting because we've had Trump in office already. So we've had 4 years. You kind of take COVID off the table. That was an anomaly, especially for our industry. But did we see any change in 2016 with Trump? Maybe asked differently, like, does it matter who's in office for short-term rentals in the vacation rental industry?
Yeah. And what matters, and generally over time, like you look at travel demand, like it doesn't really matter who's in office. There's a broad trend upwards for travel. We have more and more people spending on services, experiences, and less on goods and things. And that is a sort of secular tailwind for our industry that sort of means, and I'm broadly bullish about and future demand, no matter who's in office. What has changed over the past sort of 90 days with the new administration getting elected in is moving to a divided sort of government with Republicans controlling Congress now and Democrats in the White House. Of when we look at January 2025, the Republicans are going to control all three branches of government: the executive, the Senate, and the House, which means that they're going to be able to push their agenda through. And the expectation is that's going to be more spending, and that spending could be further more inflationary, sort of outlining those key policy proposals. So that's the big change. When we look at what that means for our industry, and we've introduced a higher inflation rate into our model. So we had expected by the end of 2025 that interest rates will be below 6%. Now we've got interest rates staying above 6% throughout 2026. All is held equal, higher debt costs to buy an investment, we think means fewer investments coming in. And that means a slightly lower supply forecast for 2025 and 2026 than we originally had in our mid-year outlook.
Which would reinforce the trends we were seeing in 2024 of improvement for existing operators. But maybe if that were to be true, then harder potentially to enter the market for a net new investor.
Yep. And like we're actually seeing slightly better now in the outlook for consumers, giving a bit more sort of stimulus to the economy, which all else held equal, lower supply, a bit more demand means we've increased our occupancy outlook and our outlook in general for RevPAR. So net, we see this as a positive for operators. We see that, and there's going to be slightly stronger performance on a RevPAR basis, but a bit weaker on the investment outlook. So if you're thinking about, like, if you are an investor and thinking about doing a deal in 2025, you might be slightly less optimistic that you're going to find a good investment.
And let's operate under the assumption that these forecasts are true, because right, every economic forecast pans out, just like we say.
No, they're all going to be wrong, but
let's say they were true. Help unpack or understand the lag time between, hey, some decisions are made in the White House, the flow through to it being felt in the housing market, or you as an investor looking to purchase a home.
yeah. And typically we don't see like what we saw during the pandemic of like, we want stimulus and the president's just going to cut a check to everyone and it's going to show up in their bank account. Like, that is the most direct stimulus that we can get. And they call that helicopter money. I think it's the technical term. Where essentially, like, how can I
I know it
stimulate
as
the economy?
the stimmy policy.
Yeah, fly a helicopter around and just throw it out of the plane and get people to start spending again. We don't expect that to happen again. What we do see is more sort of indirect stimulus of trying to get more and more corporations to invest in their employees in capital that is going to generate more economic output in long term. So, and then because we're just renewing the 2017 tax cuts that Trump had initiated during his first term, we don't expect that to necessarily be like a whole new round of stimulus coming in. But what we don't expect it to be is a drag on, if they weren't renewed, that it would maybe cut back a little bit. So on the margin, slightly better than what would have been, but and then on the interest rate side, typically what we see is there's sort of a 6 to 12-month lag on sort of changes in interest rates to then what we actually see in terms of short-term rental investment. Because of the time it takes investors to find investments, to get them financed, to go through and close on the purchase, then get the property sort of set up, furnished, renovated, and then online. And that is a lag. So if we do see interest rates start to come down, it's not that all of a sudden we're going to see supply growth start to accelerate. It could take some time to happen. That said, there are some aspects of the economy that are maybe a bit more impactful immediately. And that's sort of calling out the risk that we see around international travel to the US. Is at the same time that we've seen interest rates go up, we've also seen the dollar continue to strengthen. And a strong dollar, while it's good for me and you if we want to go to Europe, our dollar goes further. We're able to splurge on maybe staying longer and doing more things while we're there. It is not good for continued inbound travel to the US from foreign travelers. That type of travel we still see down relative to 2019 levels, and that could further be curtailed if the dollar continues to appreciate. That's something that we saw during the first Trump administration, that the dollar strengthened really throughout his term. We're already at a almost record high level for the US dollar, at least in near-term history. And if that continues, we may further see this trend of domestic travel moving overseas. Because when you look at Americans traveling overseas, we're spending now 40% more than pre-COVID levels, which is astonishing. The amount of money sort of and travel sort of exiting the country. And that is a headwind for domestic destinations. So if you're like, let's say an operator down in Destin, you really liked that I drove from Atlanta down to Destin from 2021 to 2022. Now you're probably hating that now we're trading that trip to Destin for a trip to Nice with the family because it is so relatively inexpensive to make that trip these days.
Tough decision, Destin or Nice. All right, Jamie. So we talked a little bit about what we can expect for 2025. Maybe here it's our last episode of the year. How would you summarize 2024 in maybe a sentence or two, and then what you expect for 2025 going forward?
Yeah. When we were talking at the beginning of the year, the theme I thought for the year was going to be equilibrium. That after 3 years of disequilibrium in the market, supply and demand sort of moving in very different directions, and that causing a lot of and pain in the industry and boom bust in terms of occupancy demand. 2024 really was like, and supply and demand moved right in equilibrium. Full year 2024, they were at 7%. So that's pretty exciting. As we move into 2025, my sort of theme I've been sort of brainstorming around is the year of efficiency. Of we've moved past this time where I've got to cut, I've got to sort of pull back. Now I'm looking into sort of maintaining and growing my operations. Need to figure out how to be more efficient what I'm doing, how to grow my business in an efficient way. And there's a lot of ways that the industry continues to grow, even in a time where new investment really isn't driving that growth. So efficiency is my word for 2025.
I love it. I love it. Well, that's a great way to end the year. Thank you, Jamie, again for the recap. And be on the lookout coming in mid-January for our best places to invest report. And we'll be talking about that in Jan.
Awesome. Thanks, Scott. Happy holidays.
You as well. See you, Jamie.